So thank you for taking the time to join us and meet us. It's the first webinar, hopefully, of many. We have some informative information for you. This one is going to be, we're going to start with what we know best, and we are an introducing broker in the Forex industry. My name is Alex Nekritin. I'm actually the founder of our company, TradersChoiceFX.com. And finding the right Forex broker is very, very important to your success. I mean, we've seen traders using the same exact strategy, make money with one broker and lose money with another broker. So because there's no centralized exchange, it's so important. And it happens to be something that, we consider ourselves, and I consider myself an expert at, because we've done this for already over 5 years. And hopefully we'll be able to shed some light on a lot of things. I see a lot of misconceptions out there when it comes to choosing the right Forex broker for your trading. So I should be able to give you guys some hopefully some good advice. So let's get started. It looks like the way this is set up, the trading software, I really can't see your questions the way that I have it set up on my computer. But I guess I'll go through the presentations, and my associates will answer the questions through the chat, and they're informed. And then after the presentation, we'll try to do a Q&A sessions. But the way it's set up right now is I can't see the questions. So we'll get into it real quick. We are an NFA registered firm, and it is important to understand the risks of Forex trading, obviously. So here's a quick risk disclaimer for you to read, get yourself familiar with. I'm going to leave it for a few seconds up here, so you guys can look it over. I mean, all things aside, I mean, definitely there is a lot of risk. There's a lot of potential reward and a lot of risks when trading anything, really. I mean, your money's on the line, obviously. So very, very important to familiarize yourself with this, and let's get right into the presentation now. Let's talk about the industry in itself. And like I said, remember, so there's a big thing is that unlike equities has a centralized exchange. It has the New York Stock Exchange. Futures has the Chicago Mercantile Exchange. It has the NASDAQ. So there's one centralized location. With Forex, this is completely different. It's an unregulated market, and it's called the OTC, over the counter, which means that there's no central location for this. So that means that you can be getting a feed from a bank and seeing a price feed from a bank, or it means you could be seeing a price feed from some kid sitting in his basement giving you an e-signal feed or any type of feed that he's providing that anybody could buy from someone. So basically what this means is that there's no centralized exchange. You cannot, wherever you're trading with that counterpart. And for this reason, it's very hard, it becomes very hard to distinguish between a reputable broker and a small-time bucket shop that's basically taking your trades and taking risk on all your trades. So this is something very important to pay attention to, and we're going to address and give you some clues about how you can best use your judgment to find the arrangement that's best for you. Now, here's the thing, that because there's no centralized exchange, the feed is going to differ very much. Your transaction costs are going to differ very much. The bonuses and perks are going to differ very much. Your execution and your slippage is going to differ very much. Because there's no centralized exchange, the broker can manipulate the feed. So if you look, and we've done this analysis, and there's actually arbitrage opportunities that exist. So if you look at all the feeds of all the brokers at the same time, they're not going to be showing you the same price for the same currency pair. So this is very important to pay attention to. And for this reason, it's very important to do your due diligence. Now, also to keep in mind that the brokers are separate entities from each other. And when you're holding the money, you're holding the money in their account. So what happens is the biggest concern that's going to come up with, and the first thing that you should address before you go into anything else, is the safety of your fund. So how can you determine whether the brokers you're trading with is safe or not for you? And there's definitely no sure way out there. I mean, I don't know if you guys can remember back to when I was starting out in this business between around 2005. There was a big company called Repco. And Repco was a big firm. It was a stable firm. Everybody heard about it. Everyone knew about it. And it was kind of like a staple in the Forex industry. Well, I hear some stories. I still know people today that have not got their money back from Repco in the U.S. So point being is that basically You never know for sure. But the idea is to basically put all the odds in your favor. Now, since Refco went out of business, there's been a lot of other companies that went out of business, and they were much smaller, much newer shops, and the warning signs were there. I'll give you some examples. FXLQ, Forex Liquidity, was a company in California, went out of business. There's a company in right around here in Boston area called TradeX, went out of business. People still are yet to get their money back from TradeX. United Global Markets was another company in the Boston area. It went out of business. So, and this, of course, is the biggest danger. So this is the first thing. Before you worry about spread, before you worry about execution, before you worry about, big one is everybody wants an ECN. Well, we're going to address that issue later, and the real difference between an ECN and a dealing desk and what really is going on over there. But first thing you got to do is look at the safety. And how can you look at the safety? Well, first of all, you got to look at the size of the company. This can be done if it's a U.S. firm, but right now people kind of don't want to stay away from the U.S. because, there's some trading conditions that the regulators put in place that make it more favorable to trade offshore. But at the same time, if it is a U.S. firm, or if the firm has a U.S. branch, for example, Gain Capital, they have Gain Capital U.S. or Gain Capital U.K., right? So Gain Capital U.S. is an NFA registered firm. Their information is up on the CFTC website. So you can see exactly how it's capitalized and how that capitalization compares to the other firms out there. This is the link right here that you're seeing in the middle bullet point. I don't know if you can see my mouse pointer here, but I'm sure I'm going to get better with future presentations. But at this point, this is the link. And this is a great place for you to go and see for yourself what is available out there. So for this reason, I would only, when looking, I would stick with the major, biggest U.S. firms, because at least there that if it has a U.K. branch, at least it has another entity in the U.S. that's probably owned and controlled by the same people. And you can clearly, right in front of you, there's that transparency, and you can clearly see where that firm stands in terms of capitalization. The requirement right now is 20 million. So firms got to have at least 20 million of net capital available. And for this reason, basically, you want to see that it's at least there, but you want to also look at comparison. Let's face it, what are the big U.S. brokers? FXCM, Gain Capital, which is also Forex.com, FXDD, GFT is another big one, and FX Solutions. There's other brokers out here in the U.S. as well. So when you need to pay attention, you want to make sure that this firm is at the top. You look at FXCM, Gain Capital, and GFT, these three firms, and they're going to be at least 50 million. So they're going to have way more than the required amount of capital. Now the cool thing about some of them is that they have UK branches. Now what is a UK branch? It's not in the US. So some people that are really, US is always throughout the world known as a place for safety, right? So people are inclined to keep their money in the U.S. Even people offshore know that the safer place, the most protection that somebody gets, and that's what the regulatory bodies are really here to do. They're there to protect you. So, a lot of people say that I'm so mad at the NFA, they're changing all these requirements. The NFA's and the CFTC's main goal is to protect you, the trader. So it's actually a good thing that they're in place. So the point being is that that provides a level of safety. But if you were to go to UK, they're regulated by another regulatory agency called that. And the FSA is it's like the equivalent of the NFA, but in the United Kingdom. And they also have certain requirements in place. One really, really cool thing, and one really thing that makes UK accounts, where I would feel, if I was opening up an account, I would feel actually probably a little bit more comfortable in the UK, is they have these things called segregated accounts. Now let me explain to you what a segregated account is. So let's say you open up an account with a U.S. firm. The accounts are actually all pooled together. So the firm has one bank account, and when your deposits go into this one bank account. And then the firm on their internal reporting tracks obviously your statement, your balance, and then if you want to withdraw, it comes out of that pooled account. And as you know, the insurance on any account in the bank, the FDIC insurance, it's only like $100,000 or $200,000. Now, imagine a company like FXCM, for example, with like 100,000 customers, and let's say an average deposit that we see with FX, for example, is $3,000-$4,000. So 100,000 times 3 or 4,000. It's I'm not going to do the math right now, but you can imagine it's a heck of a lot more than $200,000. So this is where the issues happen. If a company was to ever have issues or go into bankruptcy or run into any type of issue like that, your money is not protected. You're not considered a secured credit. That's the big thing. Any U.S. firm that you open an account with, you're not a secured credit. When you open your account with a UK broker, you're considered a secured creditor with a segregated account. So the accounts are not pooled, they're kept segregated, and you're a secured creditor. And the difference between a secured creditor and an unsecured creditor is that a secured creditor is the first in line to get their money back during bankruptcy proceedings. So what that means is, let me just use an example of FXCM, and I'm sure it's not going to happen. Well, I'm not just, you never know 100%, but it's very unlikely that this will happen. Extremely unlikely. But you got to look at all things considered here, right? You got to make sure that your money, hard-earned money, is as safe as possible. So, for example, if you open an account with FXCM US, and tomorrow, I don't know, something bad happens to FXCM. I don't want to throw any bad scenarios out there, but let's say something bad happens to FXCM tomorrow, and they go out of business, and you have the account with FXCM US, you are not a secured creditor, and you're not first in line to get your money back if there's a bankruptcy court and a bankruptcy proceeding. And we've seen this happen with other companies. People got 50 cents on a dollar, 40 cents on a dollar, because they got to pay their creditors first, like bonds. I don't know, like people who let them borrow money, they're always secured creditors and things like that. So they got to pay them first before you. If you open an account with FXCM UK, by FSA, by British law, by the FSA regulations, you're considered a secured creditor. So before they pay out anybody else, they have to pay you out in case of this bankruptcy proceeding. And that puts you at a tremendous advantage. There's also other specific details with the segregated account feature, and I don't want to say it's insured because that's an incorrect term. It's not insured, but there's a certain specific bond that protects your money up to a certain amount. I believe it's like around 40,000. I can find out specifically if you guys want to look more into this. You can contact me and I can find out the details specifically. But put it this way, in simplest terms, I don't want to say it incorrectly here, but you have a lot more protection up to that amount of money. So if anything were to happen, there's some kind of it's not exactly an insurance, but it's a bond type of thing that protects you up to a certain amount. So I want you guys to understand that, and if you have questions specifically, we know it, but I have to word it very carefully because I don't want to give you incorrect information. The bottom line is there's a little bit more protection on your funds with the UK broker. So actually, it's quite a bit more. It's quite a bit more. So that's basically in terms about safety and stability. And this is something, once again, if you have any specific questions, we'll do our best to answer. So the big other thing here is, taking all that into consideration, you're going to notice one big pattern that when it comes to finding a Forex broker. And a lot of people don't see it that way. They really go after the cost. They're really worried about the execution first. They're really, they like the boutique environment where you're talking to the same person all the time. And then, that's certainly very good and valuable. But what you're going to find that, from my opinion and from working in this industry, I noticed that bigger is better. Their bigger firms are more operationally sound. That way everything is handled better. Their platform is more stable because they have deeper lines of liquidity, and we're going to address that with you shortly as well. And they have better customer service because they have bigger teams that could assist you at different types of hours. For example, we worked as an introducing broker. We made arrangements with a few smaller companies. And it was literally the same three guys, and, some of them I knew the guys, and they were, one guy covering the night shift, So there's literally one person in the office covering the night shift, anything that happens, anything of your trades. Once this guy goes down to the bar and have a few drinks, you really don't know. You don't know what's going on, and that's why with a small broker, you are trusting your hard-earned money to a really small establishment, and I don't know how comfortable I would feel with it. You're going to get your account open faster. I mean, we see that all the time, When you're excited, you got a trading strategy, you want to go trade, and you submit your paperwork and your account doesn't get open for a week because it's one guy processing all accounts. That's not a good thing. So there's a lot of advantages. you're gonna find that with the bigger firms nowadays, and before that was the big thing, that the bigger firms, they weren't as competitive because there wasn't as much competition and people were not as educated about, what an ECN is and what straight through processing is and about execution, and they were slipping and things like that. But now you're gonna find that the bigger firms, they have larger pools of liquidity. So what that means is they have more money. They have more money available, and they have better relationships with the banks that can provide you better pricing. And for this reason, you're going to find that their execution is going to be better. They'll be able to take trades more easily without any slippage. Well, not without, but with less slippage, less off quotes and things like that. And you're going to just find it an overall trading experience a little bit more professional this way. And this is especially important if you're using a shorter term trading strategy. So these are some of the reasons why working with bigger brokers has its unique has its specific advantages. Now, when you're working with brokers, there's certain trading conditions that you want to take into consideration, especially like I said, you want to look at this before you select the broker, or if you're in an arrangement that's currently slipping you or that's currently not basically accommodating you in the proper way. Believe me, don't stay with them just because you're too lazy. Because we always have this term in the business, that you can't fight an urge. So if somebody's at another broker, it's going to be a lot of work for him to repaper and open another account and things like that. But believe me, your trading should be looked at like a business. And if you are trading somewhere and basically you have your profits, which is the profits that you hopefully will make on your trading, and then there's your cost. And your costs are basically, what does that involve? That's your losses, and that's your transaction cost. And that's your cost. Let's say you're using an e-signal feed, that's your cost. Let's say you're using some sort of technology, that's a cost. At the end of the day, to be a successful businessman, if you want to look at trading on a professional level, your profits, your revenue has to be bigger than your costs, and your net, that way you get a positive cash flow, right? So that's what you're trading. I wouldn't imagine that any of you would be trading to lose money, or else you probably wouldn't be in this webinar, you wouldn't be trading. So you have to look at specific conditions. And when you need to, especially in Forex, it's not like that as much in stocks because it's a centralized exchange, but especially in Forex, you really need to find the optimal environment for yourself that will allow you the best chances to be profitable in your business. So there's certain trading conditions to look at. And we're going to address some of the big ones because, we've always, ever since the NFA made some proposals and some rule changes, we always receive questions about it. And we're going to address certain specific things that you should look for. So one big one, I'm actually going to start at the fourth bullet point down here, is micro lot trade. So I'm a very, very big believer in risk management. Like I said, I traded myself professionally for over 10 years already. I trained. And whenever you make a mistake, and I noticed it, you want to be able to get back up. So the bottom line is when you get knocked down, you want to be able to get back up. You don't want to get the wind knocked out of you so bad that it takes you a long time to get back up. And you want to be able to recover from your drawdowns and from your mistakes. This is true in any type of an activity, but trading specifically, like things like online poker, same thing. So when you bet too big, so let's say you have a $10,000 account and you bet too big, you bet $5,000 in that account on your trade, and you lose $5,000. It's very hard to get back up from a 50% loss where you have to basically double your account. You have to make 100% just to get 50% back. So risk management is essential. Now, we can do another webinar about risk management. This is something that I'd like to think of myself as an expert in. But this one is about brokers. So when it comes down to Forex brokers, risk management becomes, excuse me guys for 1 second. Just taking a quick sip of water here. But when it does come down to Forex brokers, risk management can be accommodated by a Forex broker, and that's with flexible contract size. So on any account, I want to be able to trade at least as small of a lot as possible, at least a 10K lot. So with a 10K lot, every pip is $1. What I prefer is I'd be able to trade a 1K lot, where every pip is 10 cents. This allows me to really precisely determine my trade size. And by the way, rule of thumb is a little quick risk management tip aside from broker stuff. You never want to risk more than 2% of your account in any single trade. so you can get back up. This is a big, big risk management tip. It's the 2% rule. And you can read about it. There's a great book that I read about risk management by Daryl Guppy. Just look up Daryl Guppy. I think that the title of the book is risk management is a word in the title, but the guy's name is Daryl Guppy, and he talks about this 2% rule. It's like the fundamental rule of risk management. So if your trade sizes are so big, and if the broker offers only trade sizes that are too big to get you down to fine tune to that 2% rule, like for example, if he offers only standard lot, then you can get yourself in a lot of trouble that way. So this is one of the first things that I look for, other than safety of funds, is the ability to trade small. So you can really test this broker out. Let's say, for example, you're unhappy, you're trading in some broker somewhere, you're unhappy with your condition. And let's say I call you up and I sell it, or whoever calls you, another broker calls you and sells you on trading. Let's say it's a big firm, and let's say it's Gain Capital, for example, Forex.com. They sell you on trading at Forex.com, like give you all the features, tell you that they have free VPS, tell you you can get a deposit bonus, tell you that they have tight spreads on Metatrader 4, UK account segregator, all this good stuff that Gain has, which we like to think that it does. And they basically convince you to do that, to go there and open your account with Gain Capital. And then what happens is you go in there and you open up an account where the smallest you can trade is 100K lot, right? Which is standard lot. And you start trading and you're like, whoa, these guys are not what they're cut out to be. But now you would have already lost a lot of money. The nice thing about Gain Capital is it offers micro lots. So you can go in there and trade over there using micro lots and basically get a feel before risking any money, before switching your whole account, open up a tiny account and get a feel for what this broker is like in a live trading environment. So that's one big benefit. The other big question that we always get is hedging. So hedging is a rule that changed. For a while you could go long and short. What that means is going long and short on the same position at the same time. So for example, if you're in a long-term position, long Euro US, and there's a news announcement that's going to come out that's going to affect that currency pair, you can go short at the same time. So if it makes a drastic switch, you're basically not affected by that drastic move, because you have a position open in both directions. You have a bet that it's going to go up and you have a bet that it's going to go down. Now, with the US, you cannot do it at this point, but with a UK broker, you can. Okay? There's other means and ways to get around this if you want to stick with a US broker, because it's like if you trade a slightly different size. So if you have a full lot in one direction, but you do a 9/10 of a lot in the other direction, or 9.9 tenths, then it's okay. So there's certain other ways to get around, but a quick way is to set up with, to have a UK account. That's a quick way to allow you to hedge. But if you really think about it when it comes down to hedging, that it is a benefit. But for example, if there's a news announcement coming up, why don't you just get out of the position, of the long-term position, and then get right back into it after the news announcement? And essentially, you're going to pay the spread just like you would pay the spread if you went in the other direction. So this is not really a huge one that I would pay attention to. However, there's some trading strategies and some EAs, some grid trading EAs, that go in both directions at the same time. And for those specific EAs, hedging is an interesting feature that you want to have, because that's just basically how the EA was designed. And a lot of robot vendors and developers have taken this into consideration and adjusted it. There's also some programs out there, and you can contact us, we can put you in touch, that basically hold a lot of the orders on your computer before they actually put them through, which allows for you to trade with these EAs. I don't want to get into it. It's a little bit of a complicated concept to get into right now, but that's something that else you want to consider. And like I said, another option is with the UK account. Leverage, here's my big thing. A lot of people call us up and ask us about leverage when it comes to trading conditions. Here's the big thing about leverage is there's 100 to 1, there's 200 to 1. We as a broker obviously get paid the more you trade, but we advise everybody not to use this type of leverage. Once again, risk management is the most essential thing to success. And I really, really, really don't recommend that you even pay attention to the leverage. Most traders never go above 12 to 1 on their account. We notice, we see traders. They always want to have that ability to go crazy. And, some of them do at one point and they want 400 to 1 or something like that. But it really makes it's really a bad thing. It's a recipe for disaster. We rarely see anyone who uses up all their leverage succeed. And we've seen whole kinds of systems out there that used this type of leverage. You know, there was this whole group and following of traders, and their whole strategy was based on 200 to 1, and I mean, sorry, on 400 to 1, and it's almost like it's like a recipe for disaster to go that heavy. So I would not pay too much attention to that one. And, you know, I have no issues whatsoever with NFA or CFTC changing the requirement to 100 to 1. I don't think it's going to affect anything. I think it's only a good thing for the trader. And then, you know, other things that brokers have, you know, there's free perks that we're going to address. You want to have great customer service that's streamlined. And once again, the bigger is better you're going to find. You want to have multiple funding options and multiple withdrawal options. You want them to be able to take IRA accounts if that's the method of funding that you choose to use. These are some of the other things that you want to look for, but we address some of the major ones here. And, you know, we also, I don't really need to go too much in this. I want to tell you a little bit about UK brokers here, but one thing to keep in mind with the UK is that they are the servers are based in the US. That's the cool thing about it. So there's no latency. You know, it's not like you're actually trading with the UK. Like your support's still in the US with a lot of them. So if you have any issues, don't think like you're opening an account offshore and you have to call to the UK. Because to me, anything where it's offshore, it makes me nervous right away. So if I do business with something offshore, and even like us being an introducing broker, like even before this, like Gain Capitall and FXCM set up their UK branches, we were an introducing broker to some, like for example, to Cantor. We were an introducing broker, and they were in London. And it was so tough for me. Like it made me nervous working with them because, you know, there's that time difference, and you know, I'm not a super early person myself. So there's always that time difference. You know, I sometimes trade the London session and the European session. And by the time in the morning, you know, I like to sleep in sometimes and miss the US. And dealing with UK was always a little difficult. Calling them, you know, is always a little difficult. But here, don't worry, everything is going to be in the US. Any support if you're using a UK broker is in the US. Any issues is in the US. Your servers are also in the US. And you know, you definitely can use stops and limits there as well. So now here's a big one. I think any questions, guys, about this US, UK? I mean, there's some regulatory controversy going on with that right now. And, you know, there's a new proposed change that's going to be in place. So I'm sure, you know, the regulators are going to find the best way to moderate it where it protects you and at the same time gives you the freedom that you guys want. So any questions that come up, feel free to contact us. You know, please use us as your resource. We know a lot about this stuff. But now let's talk about ECN and deal desk, because that's like the second question. You know, first of all, you know, this is a typical Forex traders, this is a typical Forex traders, questions to us. You know, I want a broker that offers 400 to 1 leverage. Or maybe this is like a typical uneducated Forex trader. Again, let me rephrase that. But here's what it is. I want a broker that offers 400 to 1 leverage, 1 pip spreads on everything, ECN execution, Metatrader platform, welcome scalping, and gives me a 20% sign-up bonus. Well, you know what? I mean, it would be nice if there are, and maybe there are people who can advertise and say that. I am almost willing to make a bet on it and almost guarantee you that they're full of it, to put it simply. That this is very difficult to offer. And always, you know, after 400 to 1 leverage, 1 pip spreads and, you know, after 400 to 1 leverage, 1 pip spreads and, scalping allowed, the next question is we want it to be an ECN. So, the ECN and deal desk is a big thing, and there's, people are, you know, they've been taught through forums and through groups, and I see it in all discussions where an ECN is so good and they get such good execution from an ECN. Well, you know, it's true if it's the correct ECN. You know, it has its advantages, but believe me, it also has its disadvantages. And once again, if you have a broker with a deep liquidity pool, meaning that they have a relationship with a lot of banks, they hold lines of liquidity, so they're very liquid. They can take trades of any size. They can offset your trades, and they're not sitting there. And if they have 100,000 clients, they're not sitting there and trading against each client individually. They're aggregating. So how this works is like this: when you're dealing with the regular with the deal desk model, is basically you have an account, and the broker can do one of two things. One is you make the trade, and they trade with you. So, for example, you go long euro, they're going to go long euro to hedge your trade off. 2, you make the trade and they don't trade with you, so they actually never offset that trade. So that way, if you win on your position, they will owe you that money from their liquidity line. Could be a bad thing if they were sitting there and trading against you and hoping you would lose. But at the same time, they don't look at it. They look at it, it's called the delta hedge. So they don't look at you specifically individually. They look at all their traders. For example, all their traders trading the euro, they'll look at the net position. And they're going to take that net position. So say all their traders combined are long X amount. If they can withstand that trade, they're not going to hedge it up. So they think the euro is going to go short, everybody's long, they're going to just keep that trade on their books. They're going to accumulate. If they, at one point or another though, their liquidity pool is not going to be big enough and they're going to trade in the same direction. But the last thing that a big firm is doing is sitting there and going through your particular trade, wanting to make sure that you, John Smith, is losing. They don't look at it like that at all. They're really more concerned about about you, for you to keep trading with them and for them to be bigger, have deeper lines of liquidity, and you providing the flow. Bottom line is most traders lose anyway without the dealing firm having to trade against you. So a deal desk that's big, and if you start to win, the deal desk actually, a good solid deal desk actually really likes that. Why do they like it? Because they'll follow you. So they'll take their account, and if you go in that direction, they're going to follow you. They're going to go in the same direction as well. And they're going to pick up the spread on the trade. And if you're doing really good, they're going to even trade above you. So like, let's say you go like 10 lots, and they're going to hedge themselves, they'll go 10 lots themselves, but they see you good, they'll go more. And they'll start using that as their own position. So bottom line is the properly ran deal desk is not necessarily bad. It's not one guy, a dealer sitting in that room and looking at you and being out to get you. It's absolutely not the case where it is. So, at the same time, an ECN, it allows you a few things. First of all, an ECN is very valuable if you have a really, really, really short-term strategy. Because what an ECN is, and let me explain, now that I explained to you what a deal does, let me explain to you what an ECN is. So an ECN is basically a trading model where you have complete anonymity. Nobody knows, even the firm itself, the brokerage, doesn't know who you are individually when you're making that trade. You put your order, a buy or sell order, and the first thing that an ECN is going to try to do is match you up within that ECN with somebody that has the opposite order. So it's just technology. You want to buy, another guy wants to sell the same amount, boom. The ECN, see, I'm clapping my hands, puts you two together, and that's it, and the trade is executed for you. If it can match you up, it's going to bring you out to a market maker that's in that liquidity pool. So this could be a bank providing liquidity, this could be a market maker providing liquidity, this could be another brokerage providing liquidity, which is acting like a market maker. Now look what happens. If the ECN can't match you up, it brings you right back to the deal desk. The deal desk is essentially a market maker. It's making the market. And the New York Stock Exchange uses market makers. Market makers are essential to make the market work. They will accumulate some trades and they're going to offset some risk. It's called the delta hedge. And it's essential to have in place. So the benefit is that the ECN will try to match you up and have complete anonymity. So there's not going to be somebody out there who's going to profile your trading style and know not to take trades from you, not to take that direction from you because you're always right. So that's the benefit. Another benefit of an ECN, a short-term trade, your trades are going to flash out there. The technology itself is going to take the best bid, best offer for you, execute them, and you're going to get filled, on short-term stuff with less issues. But if you're trading, I'm not talking short term, I'm talking sub 30 seconds, sub 1 minute. But if you're trading, a strategy over that, a deal desk can facilitate you very well. And the bottom line, although ECN or STP, an STP is called straight through processing, it's a model that, for example, that FXCM uses, is basically where, your trade goes straight through the bank. They're just act as an intermediary. It's called an agency model. But the bottom line is, if you're trading a little bit longer than a minute, you're staying in your trade, it doesn't make a difference. It really, a dealing desk is not going to be that much of a negative. And the dealing desk has some specific positives. Now here's one thing, and I've seen this happen with some ECNs. With an ECN, there's anonymity by everybody. So if you get a bad fill, or you get bad slippage, or you get bad institution, the ECN is going to tell you, hey, we're just technology. We can't do anything for you. We match you up with someone else who's anonymous. A deal desk, and I've seen this happen, companies that where somebody got a bad fill or a bad trade, and they called me up and they say, hey, listen, what do I do? And I called my contact at one of these firms and said, hey, look, what can we do to resolve it? They talk about the situation. Oh, yeah, our fee went off a little bit and we get you a bad bill. They adjusted it. They will adjust. So with a deal desk, you know who you're dealing with. You know who's on the other end. You have a little bit better of a relation. So point is, I would not sacrifice necessarily a lot of things like operations, safety of funds, sizes and stability of the company, certain perks that you're going to get just for an ECN until you're sure that the market making model, the deal desk model, cannot accommodate your trading costs. Ask those questions. Come to us. We'll be happy to help you with that. Come to the dealer floor. Say, hey, can you accommodate my trading volume? I'm going to do this, this, and this. And hey, you know what? You're probably going to be talking to a sales guy. So very likely the sales guy is going to tell you, yeah, we can accommodate it. Absolutely. You know what that means. I've seen this happen before. They'll tell you anything to get business in the door. Don't buy it. Open a small account. Open a micro account. Open $1,000 account. Whatever it is small that's for you. You know, some people 100,000 is small. Some people $250 is too big. So whatever it is for you, and test it. Test it. Remember, it's so essential to have the right broker in place for your success in Forex. You wouldn't believe how essential. So test it out. See, so Gain Capitall says, I can handle your trades. We're a great firm. Even though we have a market making model, we're a great firm. We have great lines of liquidity, Gain Capitall. We have great execution and things like that. We can handle your trade. Before you go and risk your hard-earned money with it on a big level, open up a little $250 account at Gain Capitall and see if they can, and let them put their money where their mouth is, essentially. See if they can accommodate this type of trading volume. So that's another big thing to keep in mind. So I hope this sheds some light. I mean, we actually have a free report, and I'm going to show you guys a link to that free report, which you can download, which goes really in depth about dealing models and everything like that. I'm trying to keep it somewhat simple. Once again, I'm not seeing your feedback, so it's making it a little tough for me. I guess sometimes people from the other room go, hey, come on, go through the slides, keep moving through. But so I'm not exactly seeing your guys' feedback. So I'm keeping it somewhat simple, but we do have some more in-depth information. Now, trading tools, and maybe the slide should have been called trading perks. Okay? So, as I mentioned before, now that we know about execution. We looked at safety of funds first. We looked at conditions. We looked at execution. Right? And just to mention, like I said, any introducing broker, I'm not trying to cameo us, but you can talk to them if they have a similar model where they work with multiple places. They will make a recommendation. Do a chart, do an analysis of all the brokers out there that you're considering. First break it down on safety of funds. Decide for yourself, I'm only going to look at firms that have a U.S. branch that have at least $50 million on capital. Go to the CFTC website and look at all of those. So let's say those are FX Solutions, FXCM, Gain, whatever, right? Go through all those and now look at trading conditions and make a chart and contact them and say, okay, can you accommodate this, this, and this? And hear their answers, because if they won't take the time to tell you this on the phone, then chances are you don't want to be trading with them because they won't help you out when you're trading with them either. So really get the answers in place. Call them, do some live chat. Don't just blindly open an account, okay? But after you have looked at safety of funds, you want to make sure that they have the conditions. So if you need that you need to be met, then you want to make sure that the execution is going to be good. Now that you have those in place, you're probably going to be down to 2 or 3 choices. Okay? So the next thing that you're going to obviously look at, because now you address safety of funds, you address conditions, you address execution, so all that's in place. So now, hey, where am I going to get the lowest cost and the best perks? Okay? And sometimes perks are even more important than cost. A lot of the time, cost is more important than perks. But let's look at all these things. So we see a lot of traders spend a lot of money on a lot of products. We see it. It's a huge industry. I mean, hey, you know what? I mean, I have friends who sell products who make millions and millions of dollars per year, and it's good for them. I mean, sometimes these are very good products and they're very helpful. But you guys don't think of brokers as your enemy and they want you to lose. The brokers want you to keep trading. That's their goal. They want you to keep trading. So there's a ton of tools that are available through these brokers. They have webinars, they have trading rooms, they have courses, they have market commentary, They have research. They have software. For example, Capitall offers a trickle-down version of eSignal, which is like a software that costs like $130, $140 a month. Platforms, for example, like the platform that FX Solutions offers, is a phenomenal platform. I'm telling you, they're not even on our site. I'm telling you, it's an amazing platform. It allows you to do a lot of things. FXCM has various signal services. It has that daily FX website. So there's all these trading related perks that you want to look at before you go spend your hard earned money. See what you can get from your broker, because a lot of these tools can be used. Like I know from options trading, there's a company called Options Express out there. And man, they have all these calculators. And there's other people who, and all these tools on the site, there's other people who would take those same tools, package them a little differently, sell them maybe for $3,000, $4,000. So this is what's very important to take into consideration. The other thing is what platforms are offered, right? So what platforms are you comfortable trading on the platform? The big one is Metatrader, of course, and 9 out of 10 people, I'd say actually 8 out of 10 people are going to be using Metatrader. And that is a very good platform. It allows you for automation and everything. Sometimes people like other ones. Like, for example, I'll give you once again, it's a company that we don't really promote too heavily or really at all on a retail basis from our site. CMS, their VT platform, man, all these systems that people are paying money for in robots, they have like 20 of them for you to choose right on their VT platform. In my opinion, it's a phenomenal platform. And, so compare the platforms, get the demos, no question about it. Get the demos, find out what platform are you most comfortable trading. Does it meet your needs for your strategy? You know what I mean? Does it allow you to get out of your trade in pieces and see it vividly? If that's what you want to do, if you exit in pieces. Does it allow you to stagger into your trade, to add to your trade? How are you seeing your active orders? Get really comfortable. Once you have it narrowed down on the first 3 sections, get really comfortable with the platforms and with the perks that are on. One big one is VPS. I don't really need to go into the slide too in depth, but for example, if you're using a robot, there's a big issue that's going to come up. Is if you're using a robot, holding that robot on your own home computer, you're going to run into a lot of issues. You're going to have issues with your internet connection. You're going to have issues with your robot has to be on at all times. There's sometimes memory leaks in place. You're relying on your computer. What if your computer freezes? So imagine this. Imagine you're in a trade and you have an open position in place and your computer freezes. And what happens then? You're going to be basically, potentially, could be stuck in a loss because your computer will go down, your EA will stop working, and it will not be able to exit the trades for you. So this is a big issues to pay attention to. When you're dealing with your hard-earned money, don't want to leave these things to chance. So sometimes brokers, like for example, FXCM does it, and Capitall does it, is they will offer hosting. And what happens when you open an account with them, you get to host your Metatrader remotely for free. And that way you don't have to rely on your home internet connection. You don't have to rely on your home computer. And your robot is in a professional environment. Now let me tell you something. Any high-level professional trader who treats it like a business is going to use a dedicated or some kind of a virtual server to host their trading. So this is a great tool. And this is available for free. So list out the perks and compare the perks. That's the bottom line. So in addition, now that we have the perks, and there may be something like you may see a perk in there that it sells it for you. It does it. This is what I need. I need to get this. I don't want to spend a lot of money for it. I'm going to try out this broker just to get it and see what it's all about. But now let's talk about transaction costs. And this is, believe me, this is so important. Once again, they vary tremendously, and a pip is actually a lot. Because they, guys, 1 second, I'm going to take a quick water break here. They say, I remember when I was before, when I was just starting out, I was trading, but I went to a lot of these seminars and they would sell Forex, right? They would sell like Forex Made Easy, one of those. And they're like, transaction costs are so small in Forex. Your spread is only 3 pips. And your spread is 3 pips and you're trading a standard lot. That's $30 on on 100,000, your standard lot is 100,000, and your cost, look at this percentage. Look how much lower it is than it is with stock. That's so not true. Because it's leverage. Remember, you're never really seeing the 100,000. Your transaction cost is in your account. So you have a $2,000 account, right? You have a $2,000 account, and you have a 3 pip spread, and you go into a standard lot. That's $30. Your transaction cost is $30 on 2,000. That's a pretty big transaction cost. That's actually, I'm just make sure I just did this on my calculator real quickly, but let's say $30 on 1,000, for example, that's 3%. So $30 on 2,000, that's 1.5%. That's your transaction cost just for making one standard lot. That's tremendous. I mean, somebody's goal is to make 20% a year, let's say. That's a realistic trading goal. And your transaction cost is 1.5%. So your transaction cost just on one trade is almost your month's profit. I hope I'm not saying something wrong because it's just shocking to me how I'm seeing this. But I'm sure the guys from who are listening to the webinar, they see the comments doesn't make sense. But I'm pretty sure it makes sense. Your transaction cost is that big. I mean, look at it in this way. Let's say you trade 20 standard lots a month with a 2 pip spread. You're paying $400 in trading costs. That's $5,000 a year. So let's say you have a $10,000 account, and it's pretty reasonable to say that you would trade 20 standard lots a month on a $10,000 account. You're paying $5,000 a year in transaction costs. That's how big that is. And that is, so that means that on a $10,000 account, you're going to be down $5,000 just your execution. And they say no commission, no this, no that. I mean, it is there. It's in your spread. So you got to overcome $5,000 just to get to break even. 50%. And you're trying to make 20% a year. So it's huge. Bottom line is it's huge. Now, so what are your choices? Go to the broker that offers the tighter spread. Now we said that. In many cases, many cases, that's going to be a small firm. They're going to offer you really tight spreads. But there's a very good chance and there's a probability. And I don't want to give you guys a scared scenario so you don't trade Forex. I mean, you got to take it that it is what it is and you got to make the best of it, right? But there's a chance if you go with a small broker that's offering you really tight spreads, like 1 pip spreads or zero, some of them are offering 0 pip spreads. They're going to disappear with your money. They're going to go out of business. They're going to slip you. They're going to requote you. I know all that stuff is out there. There's plugins that you can put into Metatrader. They're going to do all kinds of bad things. So you need a broker with competitive spreads, good execution, but that's stable and big. So first of all, when you're analyzing transaction costs, do your qualitative stuff first. Make sure it's a safe firm. Don't even look at this other firm that didn't pass the first test and see that they have a small transaction cost. Forget about it. You should not even entertain their options. But how do you mitigate? How do you bring down your transaction costs of these firms? Well, first of all, you take the one that offers the smallest, right? You need to get the best of both worlds. Now, one thing is cash bonus. What you can get with cash bonuses is like there's 2 types of cash bonuses out there. And this way you basically use their perks to enhance your success, minimize your costs, and thus maximize your profit. After all, that's what you want to do. You want to improve your trading and be successful. One type of cash bonus is a deposit bonus. Many brokers, and I don't know if you've seen it out there, offer a deposit bonus on your trade. They offer you, for example, open an account, it's a percent match. Open an account and get a 5%. Gain Capitall offers this, FXDD offers this, FXCM occasionally offers this as well. Open an account with $5,000 or with $10,000, we're going to give you 5%. You get $500 right away. Now, how nice is it? Let's say your goal, realistic goal, is to make 20-30% just for opening and funding your account and making your first X amount of trades. You're already 5% closer to your goal. That's tremendous. So that's one way to mitigate the transaction cost. Another way to mitigate the transaction cost is per trade rebate. Now, these are offered through introducing brokers like us. I believe actually FX Street has a great program for this as well. And what this does is every single lot you trade, you're going to get some money put back in your pocket. And that puts you at an advantage. I mean, think about it. Just saving, for example, $2 for every lot that you trade on the same volume. So you're trading 20 lots a month. 20 lots per month. You're saving yourself $2 per lot. So that's $40 per month that you're saving, times 12 months, $480. Now think about it. On a $10,000 account, that puts you at 4.8% better than you would be without the rebate. And they don't cost you anything. So this is something else that you really want to keep in mind. So basically, that's transaction cost. Now, this is our broker review guide, and this goes a little bit more in depth on some points. It also covers some basics. So here's a link to get it. This will go right to the page. You just fill out one quick form and get this guide, right? So I want to tell you that. But let's quickly recap. There's nothing on the slide, so let's quickly recap here. So if you're unsatisfied with your broker, if you're just getting into Forex, if you're looking for a broker. So let's quickly recap the first steps you need to do. First, stability and safety of funds. Check the CFTC website. Make sure that even if it's a UK broker, it has a US counterparty that's big and stable. Make sure you can get a segregated account if needed. If it is a US broker, make sure it's stable. Make sure it's near the top of the industry in capitalization before you look at anything else. Next thing, features. Does this broker offer features that accommodate my trading? I need to trade microlots. Does this broker offer microlots? I mean, that's a simple elimination right there. I need to trade microlots. This broker, the smallest it goes is mini. Okay, he's out. Right? Leverage. I mean, like I said, that's a non-issue. Stops and limits. I need to place stop and limit OCO orders. What do I need to do to get that in place? Once you get that, once you get the features, execution. Talk about the pricing. Call them up. This is the strategy I want to do. How can you accommodate? Remember, ECN and deal desks are a little bit, are not what it's out there to be. Nothing. I'm not saying ECN is bad. ECN is very good. But don't sacrifice the other things available for ECN. So the next thing is execution, right? And once again, in my opinion, from what I've seen, bigger is better. Number 4 thing that you want to look at, I don't know why I'm changing the slide, but the number 4 thing that you want to look at is your perks and your costs. And I would say number 4 is your costs. Maybe the PowerPoint was a little structured. And number 5 is your perks. So really make sure you get the tightest cost and make sure you get the best bonuses, the best tools to enable yourself to have success. After all, you need one thing. You need revenue, which is you need to have the best tools in place to make money, and you need to mitigate costs. So perks and costs are very close to each other. Mitigate costs, maximize revenue, and keep your money when you make your profits. And guess what? Now you have success with the right Forex, bro. Guys, I really thank you for taking the time to listen to me. I once again apologize for that delay in the beginning. I'm sure that future webinars are going to be smoother. I hope that you find this information helpful. And listen, I want to thank you in advance for any type of feedback that you guys are going to be able to provide to us regarding my presentation. Do you want me to go more in depth, less advanced, in depth? I feel like I have a lot of knowledge that I could give you guys, that I could share with you, that I could potentially improve your trading and get you guys on the right path to success. And it's not just about brokers. I mean, that's my main business, but I've been trading for such a long time that I have a lot of knowledge, a lot about risk management, a lot about trading psychology, a lot about various strategies. And any feedback is appreciated. Any topics you want to hear me talk about, greatly appreciated. I want to thank FX Street, guys. Really appreciate you providing me the opportunity to present on your website and to be on your website. Once again, apologize to everybody for that delay in the beginning. And I look forward to hearing from you, and I look forward to sharing with you more valuable information. Thank you very much.